Ladies and gentlemen, welcome to the latest episode of Global Economic Perspective with Raymond. I'm your host, Raymond Chen. This week, the world once again finds itself gripped by a familiar yet deeply unsettled question. How fragile is the global economic order when geopolitical situations in the Middle East continue to rumble? We are witnessing not just a military confrontation between the United States, Israel, and Iran, but a multi-layered geopolitical crisis, one that is already rippling across energy markets, financial systems, and global supply chains. Today, I will walk you through this unfolding situation, and more importantly, what it means for investors, policymakers, and economies for China and Hong Kong. On the 8th of April 2026, the announcement of a 14-day ceasefire between the United States and Iran initially brought a sign of relief to global markets. Oil price briefly softened by 14%, equity markets rebound, and volatility index eased. But let's not be fooled. This was not a peace agreement. It was, at the very best, a timeout. Global markets, especially energy markets, are highly sensitive to expectations rather than realities. The ceasefire signaled a temporary reduction in immediate supply disruption risk, particularly in the Persian Gulf. As a result, Brent crude saw a short-term pullback, reflecting a partial unwinding of the geopolitical risk premium that had been rapidly priced in during the escalation phase. However, seasoned investors understand that such ceasefires in the Middle East often function more as tactical breathing space than structural de-escalation. The underlying tensions, such as nuclear negotiation, regional proxy conflicts, and strategic rivalry, remain unresolved. From a macroeconomic standpoint, this tells us something important. Instead of purely demand-supply driven, energy markets are now structurally risk premium driven. This has long-term implications for global inflation expectations. Even temporary disruptions or perceived threats can keep oil prices elevated, complicating the balancing act for central banks. And just one day after the ceasefire came into effect, the situation took a dramatic turn. Israel launched large-scale airstrikes on Lebanon, resulting in significant civilian casualties, with a preliminary report of over 250 people were killed. How terrible this is. And what does this tell us? First, the Middle East conflict is no longer a bilateral issue between the US and Iran. It is a multi-front geopolitical network, where any node, be it Lebanon, Syria, or Yemen, can trigger systematic escalation. Second, markets replies risk premium quickly. Oil price rebound sharply, reflecting fears not only the conflict will not be ended, it could even expand into a broader regional war involving key oil-producing or transiting countries. Geopolitical risk is no longer incremental. It is exponential. One single event can rapidly turn into a full-scale crisis scenario. For investors, this means traditional models that rely on gradual risk adjustments may no longer be sufficient. Instead, markets are increasingly characterized by shock-driven volatility. To truly understand the gravity of the situation, we must turn our attention to one of the most critical arteries of the global energy system, the Strait of Hormuz. And roughly 20% of the world's oil supply passes through this narrow corridor. It is not an exaggeration to say that the Strait of Hormuz is the single most important energy choke point on the planet. Now, with Iran reportedly imposing a form of blockade or restricted passage, the implications are profound. First, displaying supply shock risk, even partial disruption can send oil price skyrocketing due to the inelastic nature of short-term supply. Second, it brings up shipping and insurance cost. Tanker insurance premium surge, increasing the cost of delivered oil globally. Third, it brings strategic vulnerability. Countries heavily dependent on Middle East oil, such as China, Japan, South Korea, and India, now have to face heightened energy security risks. In a sense, the Strait of Hormuz is much more than just a geographic location. Whoever controls or threatens it holds disproportionate influence over global markets. This also explains why energy importing nations are increasingly investing in diversification strategies, including LNG, which is liquefied natural gas, and renewables and strategic petroleum reserves. Now, let's bring the discussion closer to home. For China, the situation is both a challenge and a strategic test. China remains one of the largest importers of Middle East oil. Any disruption in supply routes or sustained increase in oil price directly impact its manufacturing cost, trade balance, and inflation dynamics. However, China also possesses several strategic advantages. Firstly, diversified energy procurement through long-term contracts with countries like Russia and Central Asian states. Secondly, strategic petroleum reserves, providing a buffer against short-term disruptions. Thirdly, acceleration of energy transition. Investment in renewables and electric vehicles reduce long-term dependency. Going forward, there are a few more measures China should consider, say expanding its strategic reserves further, strengthening energy diplomacy with alternative suppliers, and accelerating the internationalization of renminbi in energy trade settlements to reduce exposure to dollar volatility. And for Hong Kong, the impact is more indirect, but no less significant. As an international financial center, Hong Kong is highly sensitive to global capital flows and market sentiment. Rising geopolitical risk can trigger capital market volatility, hence reduce investor confidence, which would, for example, lead to delays of IPO and other fundraising activities. However, crises also create opportunities. Hong Kong can position itself as a risk management hub, offering derivatives and hedging instruments linked to energy markets. Also as a digital asset innovation center, particularly in tokenized commodities and energy-linked financial products. Last but not least, perhaps most important of all, as a safe haven for capital, leveraging its legal system and financial infrastructure. In short, while Hong Kong cannot control geopolitical risk, it can monetize volatility through financial innovation. Now, let's examine how different asset classes are reacting. Gold has once again reaffirmed its role as a safe haven asset. Prices have surged with increased uncertainty, reflecting investor demand for stability. However, beyond traditional safe haven buying, we are also seeing central banks increasing gold reserves as part of a broader de-dollarization strategy. The US dollar has strengthened, driven by its safe haven status and global liquidity dominance. However, this strength is not without contradictions. Rising oil prices can widen trade deficits and increase inflationary pressures in the US, potentially complicating monetary policy. Other currencies, particularly those of energy importing nations, are under pressure due to deteriorating trade balance. And interestingly, cryptocurrencies such as Bitcoin have shown mixed reactions. On one hand, they are increasingly viewed as alternative stores of value. On the other, they remain risk assets, often moving in tandem with equities during periods of liquidity tightening. This double identity makes crypto markets particularly volatile during geopolitical crises. And for US treasuries, they have seen increased demand pushing yields lower, and this reflects a classic flight to equity dynamic. However, if inflation expectations rise due to sustained high energy price, we could see upward pressure on yields in the medium term. And this creates a complex environment where treasuries are caught between safe haven demand and inflation risk. So, you may ask, what lies ahead? In the short term, we are likely to see continued volatility. Oil prices will remain highly sensitive to headlines. Equity markets may experience sharp swings. Safe haven assets will stay supported. But the more important question is the long-term impact. And this crisis may accelerate several structural trends. Countries will double down on renewables and alternative energy sources to reduce geopolitical dependency. The world is moving toward a more geo-economic fragmented system, where trade and finance are increasingly influenced by political alliance. Companies will continue to diversify supply chains to mitigate geopolitical risks. There will be increased demand for hedging instruments, commodities trading, and digital assets linked to real-world resources. In many ways, this conflict is not an isolated event. It is part of a broader transition toward a more uncertain, multipolar world. As we conclude today, one thing is clear. The Middle East remains the epicenter of global energy risk and, by extension, a key driver of economic uncertainty. But perhaps the deeper lesson is this. Geopolitics is no longer a background variable. It is now a primary force shaping global markets. For investors, policymakers, and economies alike, the challenge is not just to react to crisis, but to anticipate and adapt it to a world where uncertainty is the new norm. Thank you for joining me on Global Economic Perspectives with Raymond. I look forward to seeing you in our next episode. Bye-bye.